So looking at a particular age cohort gives you a sort of a slice of the pie for that age group, but you've actually got to follow it all the way through. And good financial planning, in some sense, is looking at wealth accumulation and wealth preservation. Wealth accumulation phase is basically the phase when you're working. And when you're working, you've got your biggest asset is your income earning potential, your human capital. You borrow to buy a home, and you might be exposed to the housing market. These are the people typically going through mortgage stress at the moment, although an increasing number of older people are also facing mortgage stress as people get into property a little later. And so even people over 60 and 65 are facing a degree of mortgage stress. And you're building up your superannuation and other financial assets. The wealth preservation stage, your human capital is pretty much run out. You may have home ownership without a mortgage. You're relying potentially on the age pension, and you've got these other assets. And diversification becomes a much bigger issue in wealth preservation. So let me show you the wealth dynamics across the different age groups. So this is not following an individual through their lifetime, but basically looking at that ABS data and looking at the total numbers for the 15 to 24-year-olds, 25 to 34, 35 to 44, etc., up to the 75-year-olds at the end. And that is the superannuation size of the pie. So that blue total there represents the 1.2 trillion. Again, that is the focus of a lot of this industry. It grows slowly until about 65, and then people start to use it to support themselves in retirement. You can add on top of that the non-superannuation assets. So that's the cash, the managed funds, the direct shares, and the direct property. Obviously, that's a pretty significant asset. And it's potentially, as you get beyond 65, even more important than super. This was a survey done 2005-2006, before some of the simpler super changes. I think that part of those changes will push some of those red assets into the blue assets. And so I think those two things can be read together. If you then add on top of that property, for property Australians, it turns out to be one of the most significant and valuable assets that they have. So that's owned property. It's buying into property across those different age cohorts, borrowing to buy. So this is the net equity in that property. And then there's a slither on top in terms of investment property for about 20% or thereabouts of Australians. The age pension is normally thought about as an income stream, not an asset, but you can value it as an asset. It also only starts at 65, but you can calculate the present value of that asset. So even a 30-year-old can think about this as an asset that they have in terms of their retirement planning, because at some point in the future they will actually get some part of the age pension, or at least it'll be a contingent asset. And the really interesting one, I guess, there is human capital. And you can see at the beginning, the most valuable asset people have is their income earning potential. And broadly speaking, the total net worth of individuals in the 20 age group and the 30 and the 40 and the 50 is about the same. It's a very different shape of net assets, but it's about the same. And lifetime financial planning is really thinking about how do you manage your income and your spending to smooth your consumption over that period of time. You can see that property values don't fall off as people get older, and that obviously gives people maybe the opportunity, if they run out of money, to use that property or to leave it to other people. So there's a cycling back here of bequests and inheritance. Actually, I'll just go back to that one thing. The one thing to note in the human capital is that human capital goes, it stays at a reasonable value until people are about 35 to 40, or that age group, and then starts to decline pretty quickly. And that's because people get out of the workforce, fewer of those age cohorts are working, and you can see post-65 that human capital has almost disappeared. So the most valuable asset we have in managing our spending over a lifetime pretty much disappears when we've still got 20 or maybe 30 years to look after ourselves. So the extent to which we can keep working or keep some sort of income earning potential, it's a very valuable asset. What does this mean for the industry? Is that more and more of the assets are going to be in the retirement phase. So here's the assets in super at the end of September 2007, 1.2 trillion. Now APRA basically give you a breakdown of how much of those assets are owned by people in different age cohorts. And so you can see there I've said that there's about 380 billion owned by people over 60 and about 400 billion owned by people 50 to 59. The APRA data covers the industry funds, the retail funds, government funds, etc. It doesn't cover the self-managed super funds. So the self-managed super funds with the ATO doesn't provide this breakdown. it provides the breakdown in terms of members in those different age groups, but not the assets. And so what I've done is I've taken those numbers and I've sort of massaged them to try and get the total pie. So these are not exact numbers, but they're reasonably close. If you forecast ahead 10 years in terms of real dollars, so you think about assets growing at about 4% real, which would be a pretty good thing given the last sort of 4 or 5 months. But if you forecast ahead that, you think about the number of people joining the workforce and the mandated contributions that they're going to make, the mortality of some of the older people, and they're starting to sort of consume from the assets that they have, and potentially the people that are in the 50 to 59 age group making voluntary contributions, extra contributions. You get to a total pie which is in excess of 2 trillion, and you can see there more than 1 trillion, nearly 1.1 trillion, will be owned by people over 60. So the retirement assets, the pension phase assets, in 10 years' time, in today's dollar terms, could be pretty much as the whole industry manages today. And that's a key reason why I think we need to start thinking about it. But as I said, the averages hide the data quite severely. So let me try and give you some sort of breakdowns here. The ABS data gives you breakdowns of assets across age cohorts and across wealth cohorts, but not by age and wealth cohorts. So what I've taken is the 55 to 64-year-olds and basically try to sort of tease out what this might look like. You obviously, in your own funds, would be able to sort of understand your members' profile much better than this. But essentially, if you look at the 55 to 64-year-olds, and I said that the average 55 to 64-year-old has about 750,000 in assets, the bottom 60% have about 415,000 in assets, and the bulk of that comes from their claim on the age pension. So the bottom 60% have actually quite significantly less assets than the average. Wealth distribution in Australia is very inequitably distributed. If you look at the ABS study, the bottom 20% of the population in terms of financial assets, so this is not human capital or age pension, have 1% of the tangible assets. The top 20% have 61% of the tangible assets. So tangible assets are very inequitably distributed. Income is not quite as inequitably distributed, and so human capital tends to sort of bring those two things together. And obviously the age pension is designed to go to people who need it and not the people who don't need it. If you look at the top 20%, the top quintile by wealth, you can see that on average they have about 1.6 million. And so the entire sort of financial assets of that, the bottom 60% is less than the top 20%. You can see there's no claim on the age pension because there's obviously designed to be no claim on the age pension. On average, about 400,000 in super and about 400,000 outside super, and quite a lot of home ownership. And I think what is an interesting segment of the population are those people that basically have accumulated sufficient assets, they have a reasonable degree of home ownership, they get maybe a part allocation to the pension. If everything goes smoothly, they will actually be able to live relatively well, but they are exposed to risk. So what are some implications for super funds? I guess the first thing is that individuals are the risk bearers and decision makers around their super and their non-super assets, and to understand these assets becomes relatively important. And as I say, I think you will know your members better. Most people approaching retirement are in desperate need of advice around voluntary contributions and date of retirement, and they need to get this. Switzerland, which has a mandated defined contribution system, has mandated contributions which change with age. Below 35, you're required to put in 7%. 35 to 44, 10%. 45 to 54, 15%. And 55 to 64, 18%. And so in Switzerland, as you get older, you put in more in terms of contributions. I actually think in Australia, a lot of people should be putting in more, particularly in this age group. And as I say, members in quintile 4, I think, are most need of risk products or innovative products like annuities. Because if everything goes well, if there's not investment uncertainty, if they don't have health scares, if they don't live too long, they're going to be okay. But any of these risks will basically upset the apple cart. And if you start designing products for quintile 4 as the system matures, they'll be excellent products for the people in quintile 3 and then quintile 2. Just to have a look at Chile. Chile went to a mandated defined contribution system in 1980, so 12 years before Australia. And that's a slightly more mature system than ours. Obviously, Chile is a weaker economy than ours. But you can see there that retirees in Chile are moving more and more towards buying life annuities as opposed to managing the money and taking an allocated pension or what's called a phased withdrawal. You can see there that the demand for life annuities has grown from about 36% to 63% and continues to grow. If you look at Switzerland, Switzerland went to a mandated defined contribution system in 1985, so it's been running now for about 22 years. They have an age pension very similar to Australia's age pension. It provides about 25 to 30% of average weekly earnings. On top of that, they have an occupational mandated contribution system, and that's what I've got there. 80% of that is taken by way of a life annuity. Now, if you look at Australia, almost none of the assets are taken by way of life annuity. It's all by way of phased withdrawals. The question is, have we got it right or have they got it right? Is our situation different to theirs? Why do we do one thing? Why do they do the other things, etc.? I don't know the answers, but we should at least consider it. Interesting in Chile is that the accumulation phase is dominated by industry funds. There's a small number of large industry funds. The retirement phase is dominated by life insurance companies. In Switzerland, the same organizations that run the accumulation phase also run retirement, but they have much more reinsurance with insurance companies and joint ventures and various other things with insurance companies. Just to talk about the age pension as an asset, because it is a fantastic life annuity. The age pension, as I say, is paid to anyone that needs it, and there's obviously, as you would know, definitions of what is need in terms of assets and income over essentially 65. It is a fantastic life annuity in that it goes till death. It provides more than CPI. It's basically linked to real wage growth, and real wages have exceeded CPI. The approximate cost to the government of providing this for a 65-year-old is about $220,000 for a male and about $248,000, $250,000 for a female. And that's because females live on average about 3 years longer. The cost to buy this would be almost 50% higher. So if you look at the sort of the private life annuities and you look at the cost to buy the stream that you get out of the age pension, it would be over $300,000. And that is an annuity linked to CPI, not to real wage growth. This assumes real wage growth of 1%. Over the last 11 years, it's been greater than 1% real wage growth. So if real wages grow at more than 1%, the value of this is even higher and the cost is even greater. And people who don't buy a life annuity or self-insure, they need to set aside quite a significant sum of money to pay themselves the age pension. And so the age pension is a fantastic part of our system and relied upon by a lot of people. Let me talk just very briefly about home ownership, because that's also an incredibly important asset. 34% of households own their own home with no mortgage, and they have household net worth, and so this ignores human capital and claim on the age pension of about $1.1 million. Typically, these are older people, couples only, so the people moving into retirement. 35% of households own their own home but have a mortgage. Their household net worth is lower, but these are typically younger people. Couples with dependent children often have relatively high incomes, but they would be the ones under stress right at the moment. And about 30% of households are renters, and you can see the household net worth of renters is very much reduced. And so the disadvantaged in our society are the ones that basically don't get to own a home, because it is a fantastic asset. Now, a lot of those people would be very young people, 20-year-olds, 25-year-olds who haven't actually started out on the accumulation phase. But a number of those people would be single people living on their own, either through divorce or through a death or whatever, who haven't managed to yet buy a home. If you look at retirees, 65 to 74-year-olds, again, this is sort of pulling the data apart, and these may be not exactly right. But about 20% of people in this bracket here are still renting, and about 80% own their own home. The 20% of renters rely very, very significantly on the age pension. They have a small amount of other assets, which obviously will grow over time. This group here also gets quite a lot of rent assistance. So rent assistance goes to 6% of people. Community housing goes to another 3% of people. So about half this group gets rent assistance or community housing. But if you look at the other side there, the homeowners, you can see significantly more assets, a very high reliance on property. A lot of these people are asset-rich and income-poor. 65% of those people there rely on the age pension as their primary source of income. And so while they've got the assets, they haven't got them in the right pocket. So some implications, I guess, for super funds is think about the profile of your members, whether they're homeowners or renters. Home ownership is a fantastic asset. It's basically a life annuity linked to the cost of accommodation. It's an asset which doesn't decrease in value over time, so it's a reserve asset and can be left to your kids potentially. And I think we need to think more about how to unlock the value for the people who've got houses and how to get people into houses who don't have it. And obviously the government's thinking there. So let me wind this up and basically say pension assets are already quite a big pool. People over 60 have about 380 billion, but that's going to grow very, very rapidly. To make the transition to retirement seamless, people are going to require a lot of advice and suitable products. If you don't give them to them, they're going to go somewhere else for those products and advice. Is your fund, structure, expertise, resources prepared for the retirement phase? Are you giving it enough thought? And do you know what your profile of your members look like? To me, if you go back, if you have a look at this presentation later, you go back to number 7, which are the risks facing retirees. Think about how many of those risks your fund actually helps members with. Because if you don't help members with those risks, someone else will help them. Thank you.
Well, thank you very much, Justin. That was a very interesting presentation. We've got about 5 minutes now for questions. Oh, actually, we've probably got a few minutes more. You did well on the end. Does anybody have a question? We're actually going to stay down here to take questions because we've worked out that we can actually see you better from here than up on the podium. So who would like to start off with a question? It's all very quiet. I'm sure somebody must have a question. Oh, we've got one over here.
Thanks, Justin. That was great. Paul Harding-Davis from Australian Ethical. You talked about the life annuities, but they've pretty much become problematic to provide here in Australia. Can you comment on what sort of products we might be able to come up with to solve that or to fill that gap?
I mean, I've spent a lot of my time trying to understand what the problems are and probably less time yet on what the solutions are. So that is something I'm going to get onto. Certainly, providing these things are problematic. If you look at Chile and you look at Switzerland, part of the reason people use a lot more of these is because the government basically requires or supports those. So to offer a life annuity in Australia at the moment, if it's an inflation-hedged annuity, there aren't the instruments around. So if the government were to issue inflation-linked bonds, that would actually make it a little bit easier to offer these things at a better price. The second is if you are an insurance company and you offer this product and you base it on today's mortality rate and medical advances increase life expectancy dramatically, you're left basically paying for much longer. So again, the government could provide some degree of sort of longevity insurance. A lot of people don't buy these things because by the time they get to them, they're worried that the provider might not be there. So again, the government could maybe support people who buy these things and provide some sort of guarantees. So as I said at the beginning, solutions are a joint product between the government and the industry. We will need the industry to focus on innovation. We will need the government. And it depends upon organizations and their existing structure. So these kind of insurance products need reserve assets and they need sort of regulatory capital, etc. Some organizations, including industry funds, don't necessarily have those. So how do they get to that point? Do they do it via joint ventures? Should this be something the government does for people maybe over 85 or 90? I think there's a lot of potential solutions, but I don't have the answers yet.
Other questions? One up here.
Hi, Tony Snowman from Watson Wyatt. I think your presentation was excellent, particularly the integration of social security. Just trying to understand the Chilean and Swiss circumstance and whether there's a government pension as well, because as you've shown in your presentation, we have a very valuable asset in that people actually have the best of both worlds. They can invest in any way they want, draw an income, and have a defined benefit pension to fall back on if their investments fall flat or if their longevity outlasts their income. So in the Swiss situation and the Chilean situation, do they also have that fallback situation?
And it's a very, very good question. In Chile, they don't. And so one of the reasons why there is a greater demand for life annuities is because the Chileans don't have that sort of basic level of age pension, that life annuity provided by the government. There also is sort of government support for income stream and life annuities. As I said, the accumulation phase is basically run by essentially sort of industry fund type of organizations. The retirement phase is run by insurance companies. There have been issues around commissions and sales and incentives and all those sort of things. So you can actually see the solution being partly driven by what are the other things that people can claim, government support, industry structure, and various other things. Switzerland actually does have a very similar situation to us. It basically has a basic level support which is government guaranteed. It's a life annuity. Looking at it, it looks like it's approximately the same, maybe even slightly more generous than ours. It's a universal pension which I think goes to everyone, so it's not means tested. And so the demand for life annuities in Switzerland is on top of that sort of age pension. But again, there's government support for life annuities. They've actually thought that this is what people should be doing rather than managing money themselves. And the organizations that work with members through the accumulation phase are also working with members in the retirement phase. And so there's mechanisms to work it out. But industry support, industry structure, government support, etc., are incredibly important to the solution that makes sense.
Justin, you've mentioned a few things that you think the government should be doing. Are there other things as well?
Well, I think, one of the things that I said at the beginning is that when individuals make decisions, we know that there are decision biases. So left to their own devices, people will actually start saving too late, and they'll probably save too little. I think that the temptation is that when you retire and you get 200,000, 300,000, 400, or whatever it is, and you've never had to manage that over a long period of time, you don't have expertise in investment management, some people are going to consume too quickly, and some people maybe too slowly. But at the moment, we only have minimums that you must withdraw. We have no maximums. I think that's a glaring weakness. So I think about behavioral biases, and then I think sort of market gaps. Why is life annuity so expensive? Is it because we don't have the products or support? Could the government be guaranteeing certain things in particular ways? And I also think home ownership. How do you unlock the value of home ownership? Obviously, the government is looking at getting people into home ownership, but they need to think about the other side of it. And so regulation, support, guarantees, etc., become pretty important.
I can see one more question up here.
It's Michael O'Sullivan, Care Super. Justin, thank you very much for the presentation. Do you think in the best possible design of these retirement income streams of any kind should take account of the likely declining spending pattern in the cohort, say 65 to 75? There could be a sense of maintaining their pre-retirement lifestyle to a very high degree anyway, and gradually 75 to 85 declining in a lot of recreational expenditure as horse riding becomes out of the question or whatever, and then 85 to D-Day. Really, healthcare costs are the primary issue of concern, and if they can be separated and funded away from the retirement income, it ought to be possible to structure it that way. I wondered if you thought along those lines, because it is one of the virtues of an allocated pension that you can allocate money to yourself according to your likely needs.
Yeah, I attended a session maybe about a year ago by Michael Rice Walker, and he went through, they've done some work on those sort of patterns of spending in retirement. And certainly there are the active years, the first number of years where, as you say, people do a number of things differently. There's the more sedentary years where people haven't yet got health problems, and their spending patterns fall away dramatically, and then the final years. And he put that up as a reason for the lack of demand for life annuities. And I think that there are a lot of reasons why people don't have life annuities. They're taking an asset which they own, which they can potentially leave to people, and they're buying an illiquid asset that disappears, when they die. And so I don't think life annuities are what should be done with your total assets. I think the Swiss example of 80% plus the life annuity and the first pillar is probably too high. But the thing about life cycle planning, I guess, is to maintain your spending over your life cycle to a certain degree. The age pension, which is at 25% of average weekly earnings, is a good floor for maybe a majority of people. I'm sure there is a private demand to basically increase that retirement income to a floor above it if there were suitable products. And as the superannuation system matures, there'll be more and more people who want to do that. So all of these things mean that solving the problem will take a while, and it's quite complicated. Those are good points.
Thanks. We've got time for one very last question. We got one up there? No? Yes? No? Okay, well that's good probably, because we probably don't have a lot of time. If I could thank Justin very much for his presentation. I think as the questions... As the questions showed, it was a very interesting presentation. He's actually done a lot of research and, as you could tell, knows a lot about a lot of other countries and what they're doing, so I'd encourage you to see if you can capture him in the break and get more information. And I have a gift for him and myself from Bridgewater, which is a gift voucher for Oxfam, and it's a donation to education for children in developed countries. So thank you very much, Justin.
Thanks,